Good afternoon, everybody, and welcome to this edition of our weekly Think Tank for January 18. My name is Carl Capelingua. I'm the market analyst over here at ThinkMarkets, and it is a pleasure to be with you as we kick off another analysis of the week that was and the week that will be as well. We'll talk about all of that and more after we talk about the ThinkMarkets Difference, which is substantial $8 flat rate trades, your own holder identification number, unlimited phone support 24/5, and no hidden subscription or platform fees. So 4 fantastic reasons why you should choose us for your next ASX share trade. And I'll give you 10 reasons why you should switch from your current broker over to us. 10 free trades on us until the end of January. So get onto the website, download the app, and get trading with us as soon as possible. The agenda for today is to check out the key market moves from last week. We'll have a look at the COVID situation, some key macroeconomic data releases from during the week, see what the brokers have been up to, see where the value is in the Australian market today, have a look at the technical side of things, and then finish off with a look to the week ahead. Not a fantastic week for Aussie markets last week. A bit of a mixed bag, a soft start, pretty good middle, and then just closed a little bit softer towards Friday. We ended up with a 0.63% decline. Within that, though, strong performance from the energy sector. I can think of some of the charts in that sector. So Woodside Petroleum had a very strong week last week, as you can see from the chart there. We still like it here, although it may be prone to a little bit of a pullback, but happy to stick with that one. Oil Search, I note, also did pretty well. Other sector picks we have at the moment, Karoon Gas looks pretty good. STX, which is Strike. SXY, which is Cenex, and the new one we're looking to add to that list is Cooper Energy for a bit of a turnaround play. So the energy sector doing the best. Heading back very quickly to the slides, next best was information technology, but I would note most of that performance coming from buy now, pay later mega play is the only way to describe it. Afterpay, which did very, very well there. The reason for that was Affirm, their major competitor in the US, listed on the NASDAQ, and based upon the price of its listing, its valuation, or I guess let's talk in terms of price to earnings ratios, well above that of Afterpay. So investors looking back over here and saying, well, potentially Afterpay can have a much higher valuation, much higher price compared to its earnings. And we saw Afterpay do very well, and that dragged up the rest of the buy now, pay later space, which obviously helped that consumer discretionary sector. Financials looking pretty good there as well. They had a good move last week. Maybe we'll look at some of our key picks in that sector. ANZ travelling along nicely. Commonwealth Bank, not as impressive potentially as ANZ, but still heading in the right direction. Suncorp looks pretty good still, despite a pullback towards the end of the week, coming back into a support level there. But also Australian Finance Group is in a nice trend. Resimac, I think, still looks pretty good, and Money3 also still holding its uptrend for the time being. Sectors that didn't perform so well last week, I'd say consumer discretionary sector, they're having a bit of a pullback. I think they've had a great run and maybe just taking a little bit of a breather. The gold sector not looking fantastic, and healthcare, as well as the Australian dollar continues to undermine the performance of those stocks, and really the COVID situation in the US and in Europe, really causing them to struggle with their day-to-day operations. And looking at Ramsay Healthcare is probably a one to note there. It's hospitals in the UK full of COVID patients, of which they're only getting costs back from the National Health Service. So you can imagine the impact on what their earnings would have been otherwise. But it's not all doom and gloom in the healthcare sector. I would suggest a few stocks I covered on Ausbiz today, which I think look really good. I'd like to table here. Helios, which is one we've had in Think Technical a number of times. That still looks very good in its uptrend. Max 7, so M7T, is one we have covered in Think Technical. You can see the scratchings on the charts there from previous coverage. Still looks pretty good. And one I haven't covered yet, which I think looks really good, is this one here, so Probiotech, and they manufacture a number of pharmaceuticals for a number of other company, so they're sort of a contract manufacturer, but they have their own products out there as well, and that looks very good. And all three of those companies check out on the fundamental side of things as well. We're getting a little bit off topic, so let's bring it back to what markets did last week. But hey, look, anyway, there's some quick analysis there for you for a number of those sectors. The rest of the sector staples not doing so well, the rest of a muchness. Looking at the broader market here, we've got the ASX 200 continuing to compress within a range between about 67, 66 and 65.85 to the downside. As long as we stay in that range, there's not a lot of reason to throw much more capital at this market unless you can find things that you like at a reasonable valuation. And when we start to move through the range, that's when you need to have the money in. But looking at what is possible, often in technical analysis, we look at the move into the consolidation range, and then we can project that from the bottom of the range up. And I probably should have drawn at a slightly different angle, but looking at the magnitude of the gains, we could see us push into those all-time highs from February last year at 71.97. The only thing I'd be a little bit concerned about is this time of the year. Just when we're talking about seasonal patterns here, we do tend to see a bit of weakness around this time. So we may sort of muck around here a little bit longer before, and it's sort of second week of Feb, back half of Feb, that we start to do very well, because if you look at the period from March through to May, that tends to be the best time of the year. So just a little bit of short-term caution, but longer term, I can't see anything in the chart that wouldn't suggest we cannot continue higher. And the Nikkei is continuing high at the moment. That was up 3.74% for the week. Shanghai Composite, a small pullback, mostly towards the back end of the week, and the US markets also having a softer close, but down not that much, 1 to 1.5%. Europe down a little bit more, around about 2%, depending on which market you're looking at. We saw a bit of a rise in the US dollar, as we'll see on the next slide, and that's caused base metals prices just to pull back a little bit, but nickel's still managing a 3% gain. I can't see anything majorly sinister in there. Zinc, 4%, is not fantastic. Iron ore pulled back in China. I'm not as concerned about that because it's holding very, very steady in the US dollar price at the moment. That's despite that US dollar price rise. So we've just got to continue to monitor that situation there. And just, there is a little bit of a disconnect, but we'll keep an eye on it. Gold prices, I should say precious metals prices, under some pressure on the back of that US dollar rally, and it is going to be on screen now, which is up 0.75%, which caused obviously a fairly similar fall in the Australian dollar. Energy prices remained firm, certainly West Texas crude oil up 0.34%, but Brent crude having a little bit of a pullback after a great run, down 2%. Good to see bond yields coming down. That does help the stock markets. It also helps some of those higher growth areas of the market like technology, and I'm going to say we're probably edging back around about 1% on those. Having a look at how this crisis compares to the last crisis, pretty similar, and if you potentially a little bit of upside here before a little bit of a dip. A little bit of fun there. Don't take that too seriously. We're just really just seeing how history doesn't necessarily repeat, but looking at that chart, it certainly rhymes. What's causing this crisis? Well, it's the COVID situation, and just a very quick look at this because it's certainly in the market, and whilst it's not hurting markets, of course at the moment markets are focusing on Biden stimulus and amazing amounts of cash being thrown at the problem rather than the problem itself. But we will just keep an eye on this at elevated levels in the US and a promising downturn in Europe. United Kingdom also heading in the right direction, and we're seeing Japan also moving in the right direction as well. So some easing there, but still the single biggest issue facing the global economy in 2021. One of the potential issues, this sort of bit of theory going around markets at the moment is that we're going to see a spike back up in inflation towards the second half of 2021. I don't agree with it. I don't think I can see an environment where we're going to see large price increases. I just think that there's too much slack in the US economy, in the UK, in Europe, in terms of jobs lost, consumption. I can't see with that much slack in the economy where this inflation is going to come from. And we've been in a deflationary environment anyway for the last 20 years. So I think the data sort of confirming my suspicions, and maybe that's why we saw a bit of a reversal in the US dollar and some of those bond yields as well. and the 0.1% print there, less than expected and less than the previous, and that's consumer price inflation. And then we've got wholesale inflation also coming in better than expected. And yes, we did have a little bit of a blip, but that's a COVID adjustment, and I think we're going back more to the norm sort of down here. Having a look at industrial production, you could call it a blip. It's doing very, very well, because it's certainly at odds with some of the other data we're going to see from the US from last week. And retail sales, you can see coming in on the downside there, worse than expected, minus 0.7%, but slightly better than the previous minus 1.4%, I should say. And continuing that theme of weaker data for the US, we saw weekly jobless claims rise to 965,000, and the University of Michigan Consumer Sentiment Survey tracking lower again. So all in all, we can say that inflation not around, economies softening, COVID situation still at elevated levels. Well, you can see plenty of reasons why we would continue to see stimulus thrown at the market, both from a monetary side of things and a fiscal, so government side of things as well. In terms of broker moves, looking at a couple of the key moves from last week, Altium, which is a big technology company, they, in line with a couple of other of those big techs, have lowered their profit guidance for the first half, and that has caused brokers to downgrade their price targets for the stock. You can see Citigroup lowering their price target from 36.50 to 32.20, retained a neutral rating, and on that update they said that potentially the company has passed their low point in growth and maybe can return to that growth in 2021 as the pandemic impacts subside. Still, adjustments to fair value as a result of the amended expectation sees the price target decline. So a bit upbeat there, not as upbeat from some of the other brokers though. 42 to 35, the target price down at Credit Suisse. They retained their outperform rating. They said that COVID is clearly the main driver of their underperformance. H2 pipeline is strong, but downgrading earnings estimates because risks remain elevated. Jefferies went from 39.80 to 32, so we're seeing 20-odd% drops in price targets here. Retained the hold rating. They didn't like the update, said it was worse than expected, and they can see continued deterioration into the second half as Europe continues to struggle. Macquarie lowered their price target from 35 to 31, retained their neutral rating. Ongoing impact of the pandemic once again, and also China licensing issues, potential recovery in the second half, but weakness in operating environment deserves the earnings downgrade and the lower price target. Looking at what the consensus is, no strong buys, 4 buys, 11 holds, no sells, no strong sells. The mean target of 36 does indicate a little bit of upside, but maybe some of the brokers in that sample are yet to downgrade their price targets. And the problem for Altium and a problem for a number of these other previously high-flying tech companies is this line here, and that's their price to earnings ratio. So they have had lots of growth in the past to justify these high PEs, but because of the pandemic, a lot of that growth we've seen is starting to disappear, and they're left with high valuations, and that is why we are seeing the prices adjust down to bring these valuations down as well. So a little bit of trouble in that sort of big tech space. In terms of outperformance last week, and we know the retail sector has done very, very well. We've seen half a dozen, in fact probably more than that, companies come out over the last couple of weeks and upgrade their earnings estimates. So compare and contrast with Altium, upgrade their earnings estimates for the first half. Premier was the one that did it last week, and they are expecting a very strong first half on the back of sort of a 30-odd% increase in their revenues. So Citigroup has increased their price target from 20.60 to 25, a nice bump up there, but only maintaining a neutral rating based upon where the current price is. Credit Suisse raised their price target from 20.39 to 23.09. They're still neutral. They're just noting, obviously, as well that the price is already close to their target. Online sales performance was particularly pleasing. Morgan Stanley retained their 1840 price target, so they're a little bit behind the curve there. They are concerned that the recent pandemic-induced momentum may decline in FY22, and UBS actually downgraded their rating from buy to neutral, but raised their price target to 24.50s. They said the first half trading update indicates earnings are well ahead of their expectations, but they are concerned that some of that is already priced in. I'm not so sure. I think the chart looks certainly very strong at the moment, and the key piece of data for me last week was the household savings rate in Australia has risen to 18.9% according to the RBA, and that's up from about 5% pre-crisis. And that just means that we have a hell of a lot of ability to spend money this year, 2021, and potentially into 2022 as cash balances start to normalise. Now, some of that's going to remain saved, given that we are in, not so much here in Australia, but we're still in a bit of a crisis environment. Some of it's going to find its way into the share market. Some of it's going to pay down debt, but much of it, I think, will find its way into retail. So predicting good things ahead for the consumer discretionary sector and certainly for Premier Investments as well. Having a look at the overall market, we're trading on a price to earnings multiple of just under 20, which is better than the rest of the world. And that hopefully will help us if there is any short-term seasonal weakness in the market. Having a look within our market and the individual sectors, the material sector remains the best value despite its recent price rise, but that recent price rise has pushed the PE up slightly, but still at 13.8, quite cheap. Comparing again to the market of about 19.9, looking also cheaper than the market. Property is a bit cheaper there, financials, but they tend to trade at lower PEs anyway, and the rest are at or just above market. And we will note info technology still the highest PEs by a long way into 65.9. Healthcare very high as well, and that's because CSL, Cochlear typically trade in sort of around about 40 PEs because they have had fantastic growth. That growth has disappeared, and that's why we're seeing share prices struggle. Having a look at how broad the market rally is, how many stocks are participating in the rally. Well, this is a technical indicator here, and we're looking at the number of stocks that are trading above their respective moving average periods. So that's about 3 months there. That's 1 week. And this is out to 1 year, and it's good to see that the majority of stocks are trading at their above their 3-month moving averages. We did see some late weakness come in during the week, and that's pushed some of those short-term trends down, but overall still fairly positive. This green line is the best of the best. That's the record high. The red line is the worst of the pandemic, so at least we're still a lot closer to the best than we are to the worst. But there has been some moderation over the last month as we continue to consolidate within that trading range we discussed earlier. Okay, having a look at the week ahead, the first week where we really start to get some or return to normal programming. And the first one we'll get this week is on Wednesday, the Consumer Sentiment Survey from Westpac. Then we get the Conference Board Leading Index on Thursday, the Melbourne Institute Inflation Expectations, and the big one for the week, our unemployment data. Also on Thursday, some manufacturing data and retail sales coming in on Friday. Having a look around the world, data dumped today in China. That's out shortly, or probably out by the time you listen to this. And we've got GDP, fixed asset investment, industrial production, retail sales, and the unemployment rate. Later in the week, nothing major there. Some inflation data in Europe. Heading on to the next page, we've got Biden having a speech on Thursday, an ECB interest rate setting meeting, weekly unemployment claims, some housing data in the US here, and finishing the week with some manufacturing and services PMIs. Well, that's it for today. You can catch all of our other market updates at our news section there, market news section, link on screen. You can follow me, all the ThinkMarkets handles on Twitter. In terms of upcoming events, we'll have the Ask the Experts coming up on Wednesday. That's where you get to tune in and ask me anything about your stock. Now, you do need to register for that one, so get onto our webinars section of the website and put in your details and catch me on Wednesday at 12 p.m. After that, on the 27th, we'll have a Think Learning on an introduction to technical analysis, and then on the 10th of Feb, we'll have a 3 small caps stocks to watch in 2021. The disclaimer before I leave you says that everything we have discussed is general in nature. Read this disclaimer very carefully before you act upon it. We are a regulated Australian broker. We do have some products that could see you lose more than your deposits. So give us a call or consult the website for further details. It has been a pleasure being with you this morning. Hopefully you got lots out of it, and all the best for your trading. Until we catch up again. Bye-bye for now.